Right now, the United States is facing a problem that almost nobody is talking about openly, even though it's already reshaping the entire economy. It's not a recession headline, it's not a market crash alert, and it's not something happening years from now. It's a quiet, growing cost that is already crossing $1 trillion a year. And the reason this matters is simple. This single number has the power to affect your mortgage, your credit cards, your savings, your taxes, and even how stable the economy feels over the next decade. This isn't about politics, this is about math. And once the math stops working, everything else has to adjust. Before we go any further, if you want calm, clear explanations of what's really happening behind the headlines, make sure you like this video and subscribe to the channel. These shifts don't arrive with sirens. They arrive quietly. And understanding them early makes all the difference.
For most people, government debt sounds abstract. It feels distant, boring, and disconnected from daily life. But interest is different. Interest is real money. It's cash that leaves the system every year before anything else gets funded. And in the United States right now, interest on government debt is approaching $1 trillion annually. That's not spending on roads, healthcare, or defense. That's just the cost of borrowing in the past. To understand why this is becoming a serious problem, we need to look at how things used to work. For decades, the U.S. government benefited from a unique position. The dollar was the world's reserve currency, and U.S. Treasury bonds were considered the safest asset on earth. Whenever the government needed to borrow, there were always buyers. Pension funds, foreign governments, banks, and investors all wanted treasuries. That strong demand kept interest rates low, even as debt kept rising.
Low interest rates changed everything. When borrowing is cheap, debt doesn't feel dangerous. You can roll it over, refinance it, and keep moving forward. That's exactly what the U.S. did after the 2008 financial crisis, and again during COVID. Trillions were borrowed, but rates stayed near zero. The system looked stable because the cost of debt was invisible. That era is over. Interest rates didn't just rise, they reset. And when rates reset, the cost of carrying old debt changes dramatically. The U.S. currently has more than $34 trillion in federal debt. Every year, a large portion of that debt matures and has to be refinanced. It doesn't disappear. It gets replaced with new debt at current rates. That's where the problem begins.
Just a few years ago, the U.S. government was paying around $300 billion per year in interest. Today, that number is closing in on $1 trillion, and it's still rising. Interest is now one of the largest expenses in the federal budget, larger than defense and growing faster than almost anything else. This is where Washington gets uncomfortable, because interest doesn't vote, it doesn't create visible benefits, and it can't be negotiated away. Every dollar spent on interest is a dollar that can't be spent somewhere else, or a dollar that has to be borrowed again. What makes this situation especially dangerous is that it feeds on itself. Higher interest costs mean larger deficits. Larger deficits mean more borrowing. More borrowing means more exposure to interest rates. And when rates stay elevated, the cycle accelerates. This is what economists call a debt spiral. And once it gains momentum, it becomes very hard to slow down without painful choices.
Most people assume the government can just grow its way out of the problem. In theory, strong economic growth can help. When GDP grows faster than debt, the burden becomes manageable. But the numbers matter. Growth would need to remain consistently strong for years while interest rates come down at the same time. Historically, that combination is rare. Another option is inflation. Inflation reduces the real value of debt over time. But inflation also raises borrowing costs, hurts purchasing power, and creates political backlash. It's not a clean solution. It's a trade-off. The third option is fiscal discipline, spending cuts or higher taxes. But those are politically explosive, especially in an economy already dealing with higher living costs. And the fourth option is the one nobody likes to talk about, letting markets force the adjustment by demanding higher yields. That's when governments lose control of the narrative.
This is why the interest problem isn't being discussed loudly, because there is no easy answer. Every path forward involves real pain somewhere in the system. What makes this even more important is that U.S. interest rates don't just affect the United States. They anchor the global financial system. When U.S. Treasury yields rise, borrowing costs rise around the world.
Mortgages become more expensive. Governments pay more to issue debt. Businesses delay investment. Asset prices adjust. Foreign governments and institutions hold trillions of dollars in U.S. treasuries. They watch U.S. interest costs closely. Confidence matters. As long as markets believe the U.S. can manage its debt, demand remains strong. But confidence is fragile. It doesn't disappear all at once. It fades gradually, then suddenly.
For everyday Americans, the effects show up quietly. Mortgage rates stay higher for longer. Credit card balances become harder to manage. Auto loans stretch budgets. Savings accounts look better in the short term, but inflation eats away at purchasing power. Retirement portfolios face more volatility, especially those exposed to long-term bonds. This is why this issue matters even if you never think about government debt. Interest is the transmission mechanism. It connects federal borrowing to household finances. The most important thing to understand is that this isn't a crisis announcement. It's a slow structural shift. These are the kinds of problems that develop over years, not days. But once they reach a certain scale, they limit choices. Governments become reactive instead of proactive. Policy becomes about damage control instead of planning.
History shows that sovereign debt problems don't arrive with countdown clocks. They arrive when interest costs crowd out flexibility. When every decision becomes harder because too much money is already committed to the past. The U.S. is not alone in facing this challenge, but because of its central role in the global system, its response matters more than anyone else's. What happens next depends on growth, rates, demographics, and political will. No single factor decides the outcome. But ignoring the interest problem guarantees fewer options later. If you've made it this far, you already understand more than most people. And this is where your voice matters. Share this video with someone who thinks debt doesn't affect them. Leave a comment with what you think happens next. Do rates come down fast enough? Or does interest keep tightening its grip? Conversations like this are how awareness spreads before panic does.
These shifts don't make headlines until they've already done their damage. The goal isn't fear, it's preparation. Because history teaches one consistent lesson. Debt problems don't feel real until they become unavoidable. And by then, the cost of not paying attention is already locked in.